I'm not suggesting that people should rush out and buy stocks today, tomorrow, next week, or even next month. In my view, it completely depends on your individual situation. But you shouldn't be buying stocks unless you expect to hold them for a very long period of time, and unless you are both financially and psychologically prepared to stick with them. With 2026 right around the corner, market conditions are unusually complex. We have the Federal Reserve just beginning to cut interest rates, which historically has been a positive signal for stocks. At the same time, we're facing a new and fairly extreme tariff policy, which is traditionally bad for business. Stock prices remain elevated, the Buffett indicator is flashing red, and the country is sitting on more than $36 trillion in public debt. In this video, we're going to try to understand Warren Buffett's thinking on 3 key topics: his general investing advice given these conditions, whether we should be buying or selling stocks, and how much cash we should be holding. One of the most puzzling aspects of Warren Buffett's portfolio right now is his cash position. He's holding more cash than publicly traded U.S. stocks. At present, Berkshire Hathaway holds over $300 billion in cash and short-term investments, which represents about 27% of its total assets. That's an exceptionally high level compared to the roughly 13% average over the past 25 years. This has also resulted in Berkshire effectively owning close to 5% of the entire U.S. Treasury market. Beyond maintaining liquidity for insurance obligations, the question becomes whether this buildup of cash is mainly about reducing risk due to high market valuations, or whether it's also a strategic move to prepare Berkshire's balance sheet for a smooth leadership transition, giving Greg Abel maximum flexibility and a clean slate for future capital allocation. Are you encouraged that you might see some attractive opportunities coming your way? Yeah. Well, I wouldn't do anything nearly so noble as holding back on investing just so Greg could look good later on. The amount of cash we have is there because we would spend it if the right opportunity came along. We came pretty close to spending $10 billion not that long ago, for example, and we'd have no problem spending $100 billion. Those decisions aren't difficult. When something is offered to us that we understand, that makes sense, that offers good value, and where we don't worry about losing money, we act. If we've got $35 billion in treasuries right now, we'd much rather be in a position where that number was closer to $50 billion. But that's just not how the business works. Over the years, we've made a lot of money by not feeling the need to be fully invested all the time. Investing is a treasure hunt. Every now and then you find something. Occasionally, very occasionally, but it will happen again. I don't know when. It could be next week, or it could be 5 years from now, but it won't be 50 years from now. At some point, we'll be flooded with opportunities that we'll be glad we have cash for. It would be more fun if it happened tomorrow, but that's very unlikely. Very, very unlikely. Still, it's not unlikely that it happens within 5 years. That explanation is about as clear as it gets. Berkshire is sitting on so much cash because Buffett simply can't find enough reasonably priced opportunities to invest it. He wants to put the money to work and is constantly looking for places to do so, but today's market isn't offering the kind of value he typically demands. Put simply, stock prices are too high relative to their underlying fundamentals. On average, stocks are trading at about 30 times earnings, roughly double the historical average of around 16. When stocks are priced this expensively, the only real alternative is to let cash pile up. But under current conditions, I don't mind building up the cash position at all. When I compare the alternatives available in the equity markets with what's going on in the world, holding cash looks quite attractive. So if stocks are this expensive, the obvious next question is whether we should be selling. Once again, let's look at what Buffett has actually done. In 2025, excluding the fourth quarter, since those numbers haven't been released yet, Berkshire Hathaway sold a total of 21 stocks. When you add those sales together, they account for about 9.59% of the portfolio, or roughly $25.6 billion. That level of selling is far from insignificant. By comparison, Buffett bought 29 stocks during the same year, which is 8 more than he sold. However, those purchases were much smaller in size. Altogether, the stocks he bought represented about 4.72% of the portfolio, or around $12.6 billion. In simple terms, he sold about twice as much as he bought. This doesn't mean that we should all rush to sell everything we own, but it does suggest that we should be more cautious in how we manage our portfolios and be prepared in case conditions deteriorate. The main thing to remember is that you're not going to time the bottom, and nobody else can do it for you either. When you buy a stock, you need to be mentally prepared for it to fall by 50% or more. I pointed out a year or two ago in an annual report that there have been 3 separate occasions in Berkshire's history when its stock price dropped by 50%. 3 times. If you were holding it with borrowed money, you could have been wiped out. I don't know if today is a great day to buy stocks. I do know that it will work out over 20 or 30 years. I have no idea if it will work out over the next 2 years. I don't know whether you'll be ahead or behind on a stock you buy on Monday morning. If you look at the stocks Buffett has been buying, they're not Nvidia. They're not Palantir. They're definitely not Coinbase. Instead, they've been somewhat unexpected value plays. United Health is one example, a stock that fell around 50% this year following the controversy surrounding its CEO. Despite that, earnings have now fully recovered, and the stock is still trading at a price-to-earnings ratio of about 16, which makes it look like a value opportunity. Another notable purchase was Google. It's unclear whether this buy was directly Buffett's decision, but it was relatively large, and Buffett typically handles the bigger moves. This could end up resembling his Apple investment from a decade ago, where he didn't see Apple primarily as a tech company, but as a consumer-focused business with a sticky ecosystem. Google has been generating enormous net income over the past few years, essentially printing money. Sales growth has been strong as well, and until recently, the stock was trading at a P/E ratio around 20, which is cheap given today's market. If we follow Buffett's approach, the takeaway is to be cautious with highly speculative growth stocks and focus more on conservative companies that the market has overlooked. The beauty of stocks is that they occasionally trade at ridiculous prices. That's how Charlie and I made our money. Ben Graham talks about this in Chapter 8 of The Intelligent Investor. Chapters 8 and 20 are really all you need to understand to do well. Chapter 8 introduces Mr. Market, your hypothetical business partner. The beauty of Mr. Market is that he's kind of like a psychotic drunk. He behaves irrationally and does strange things over time. Your job is to remember that he's there to serve you, not to advise you. If you keep that mindset, you'll realize that the thousands of prices he offers every day across nearly every major business are often wrong. He makes mistakes for all kinds of odd reasons, and all you have to do is occasionally take advantage when he offers to buy from you or sell to you at an unreasonable price. Mispricing is built into the system. Right now, Mr. Market is pricing many stocks very high, companies like Nvidia, Snowflake, CrowdStrike, and Shopify. But there are still moments where he loses his composure and sells good businesses cheaply. United Health is one Buffett-style example. The reason it fits Buffett's approach is largely because of its size. Buffett can only buy large companies since smaller ones wouldn't move the needle for Berkshire. This is where individual investors have an edge. We can invest in companies of any size, and if they perform well, it can meaningfully impact our net worth. That's why Buffett often talks about looking small. We assume there are more opportunities when you're working with smaller amounts of capital. That's always been true. As you go down in size, you encounter companies that are less followed, which creates more inefficiencies. It's much easier to find mispricing when you're buying 100,000 worth of stock instead of 100 million. If you're working with very small sums, there are almost always inefficiencies somewhere that you can take advantage of. What this really means is that instead of focusing on massive companies like Amazon, Apple, Tesla, or Nvidia and expecting them to prop up the global economy, we should be paying attention to small cap stocks that nobody is watching. Buffett prefers simple, understandable businesses. If he were investing with a small amount of money today, he might look at companies like Douglas Dynamics, a snowplow equipment manufacturer with strong and consistent sales and earnings, or Park National Corporation, a conservatively run community bank with a long dividend history, or Innis Inc., a micro-cap company that produces steady free cash flow with minimal debt. All of these businesses have relatively small market caps, around $1 billion or so, and trade at reasonable prices relative to their fundamentals. Using Forecaster, the sponsor of today's video, you can dig into a company's raw fundamental data and view its long-term history on a graph. For example, with Innis Inc., you can see that net income has been fairly consistent over the past 20 years, aside from a couple of negative periods. Douglas Dynamics, meanwhile, has been growing revenue at roughly 15% per year, which is impressive for a stock trading at a P/E ratio below 20. Net income has also been stable, aside from one major loss year. I'm not telling you to buy these stocks, but they're useful examples to help you start your own treasure hunt for overlooked small cap opportunities. The idea is to examine many stocks and then choose one. Those who turn over the most rocks tend to win. That said, there's one major issue we need to keep in mind when it comes to U.S. stocks. The country is currently running a fiscal deficit that isn't sustainable over the long term. We don't know whether that means trouble in 2 years or 20 years, because the United States is unique. But as a famous economist once said, if something can't go on forever, it will eventually stop. What we're doing now is unsustainable. This data from the Federal Reserve Bank of St. Louis shows that over the past century, the U.S. has run a budget surplus only 8 times. Every other year has been a deficit, and over time those deficits have grown larger. Today, the annual deficit sits at about $1.7 trillion. Persistent deficits cause national debt to balloon, and U.S. national debt has now surpassed $38 trillion. That works out to roughly $111,000 of debt for every person in the country. At a Berkshire shareholder meeting a few years ago, a question highlighted the risks of this level of debt. The questioner noted that U.S. national debt was estimated at $31 trillion at the time, about 25% of GDP, and that the Federal Reserve had signaled its intention to monetize that debt by printing trillions of dollars, even while claiming to fight inflation. The concern was whether the U.S. dollar could eventually lose its status as the world's reserve currency. We are the reserve currency, and I don't see a viable alternative. Nobody really knows how far you can push a paper currency before things spiral out of control, especially when you're the world's reserve currency. You don't want to try to pinpoint the exact moment when it becomes a problem, because once that happens, it's over. We need to be very careful. We all learned Keynesian economics and applied it during World War II to great effect. Inflation was kept in check during the war, but after it ended, inflation rose rapidly. It's easy for America to do too much, and once people lose faith in the currency, behavior changes dramatically. The economy changes and all kinds of unpredictable things happen. I can't predict them, and neither can anyone else, but I do know they aren't good. The Buffett-style way to prepare for a scenario like this is straightforward. Buy high-quality businesses at fair prices run by good managers. Those principles are simple but powerful. If you follow them, you don't need to worry too much about debt monetization or inflation, because strong businesses can raise prices over time. You also want to avoid companies with excessive debt, since leverage adds risk that you don't need in today's environment. If you focus on smaller opportunities, keep some cash on hand, avoid overvalued stocks, and stick to these basic principles, you'll be well positioned for whatever 2026 brings. Thank you to Forecaster for sponsoring this video. If you want access to their deep historical data and tools to graph company fundamentals, you can click the link in the description to get 10% off.